Good afternoon. My name is Dean Tenney. I'm coming to you from my studio in fabulous Las Vegas. We take requests for lectures on the YouTube channel, and one of those requests was for Series 7 math calculations. And so that's what we're going to be doing today. We're going to be doing some calculations. I didn't put every calculation depending on your provider. If I didn't put it in here, it's probably because I didn't, think it was important enough to cloud your mind with. I do have some in here that are more testable than less testable, and in terms of probabilities, and I'll probably comment along the way on that as well. So, um, organization, usually I do the math. So the reason the request, I guess, came in, I don't have one place where I put formulas. The formulas you need are typically found in the lecture. For example, current yield is found in that lecture on that particular thing, whether it's common stock or preferred stock, or it's a bond, or, break evens are found in the options lecture. So, when people are talking about a data dump page, some people like to have like a formula page. Again, it's, up to you. Our time together is a buffet. Take what you like, leave what you don't. I personally don't like a formula page. I like to have in my brain housing group my formulas where I actually need them. When do I use them, I guess is what I'm saying. But that's up to you. And so this is just kind of a laundry list. There isn't really a narrative thread to this. This is just the calculations I think you should be comfortable with as a Series 7 test takers. That's kind of the game plan. All right. Well, the first thing you want to be comfortable with is working capital. So we'll start with the balance sheet. And what we want to be comfortable with is working capital is current assets minus current liabilities. So let me just put that in here. I'll just make up one. Current assets are cash or things you plan to turn to cash within the next 12 months. And so let's say the company has 40 million. Let's get a better color than that. 40 million in current assets. Whoop. And let's say that company has $10 million in current liabilities. And you would tell me on your exam that this company has, this company has 30 million in working capital. All right, so that's our first one. Now, there's a couple of other formulas that are based on that, so let's talk about some of those. Now, of the current assets, some of the current assets are inventory. And you wouldn't want to have to sell your inventory to pay your bills because, if you have to sell your inventory to pay your bills, you're probably not going to get the kind of price you'd like to get. And so we also have this concept called quick assets. Quick assets are the current assets less the inventory. So quick assets is current assets less the inventory. So in our example, let's say that of this $40 million, that 20 million of it is inventory. And so our quick assets would be 20 million. Right? We had $40 million in current assets. Cash or things we plan to turn to cash within the 12 months. By the way, this comes from the balance sheet. This is a balance sheet calculation. And the balance sheet is a picture in time of a particular company, right? So this is a picture in time what this thing looks like. And remember, we're going to, this won't be there for us, but we do get as a shareholder the balance sheet as of the end of each quarter, 3 10Qs. And then we get that 10K. We get a 10K as well. All right. So another thing you should be prepared to answer is what happens to working capital. Now, this would be a bad draw, but I'm wishing for you a dream draw. But what would be the effect on working capital if a company declares a dividend? Now, remember, you do not have a right to a dividend. You only have a right to a dividend if declared by the corporation. But once that company declares that dividend, it becomes a current liability. So declared dividends, once the board does it, becomes a current liability. Means it needs to be paid within the next 12 months. And so if we say the company, I'll just do one here. Let's just get a different color highlighter. let's say it's the same scenario. We have a company with $40 million in inventory, and the board gets together and declares $200,000 in dividends. The board declares $200,000 in dividends. So now we owe $10,200,000. So that means our working capital is now going to be $20,800,000. And what I've illustrated there, I don't think you're going to have to do the math on the test here. What I'm illustrating, however, is that the effect of declaring a dividend, is it makes working capital decrease. All right, so be careful. When they declare the dividend, working capital goes down, but when they pay it, it's going to have no effect. So let me show that to you. I mean, and once we pay the dividend, right, we have less of an asset called cash now. So I'm just showing the effect of paying the dividend on the payable date. So we just sent out checks totaling $200,000. So that's now going to be $39,800,000. And now minus, the minus sign isn't big enough here. So I've been doing it with the annotation, and now we have 10 million because we just spent 200 on the dividend, paying the dividends. And please note, there's been no effect when we actually pay the dividend. So be careful what you're being asked. If you're being asked, what is the effect on a company's working capital when the board declares a dividend, right? When they declare it, remember, it goes down. I just illustrated that to you. So let's put this here. This is the declared date. And this one is the payable date. And so declared goes down, payable, no effect. All right, so that's one of our math calculations we should be prepared to do. Let me clean up the slide. Just clear that. Working capital is current assets minus current liabilities. I gave you an example of a company with $40 million in current assets, $10 million in current liabilities, and we determined the working capital was $30 million. And then we showed you the effect on declaring a dividend. We said working capital decreases, and we showed you the effect of paying the dividend, no effect. The board takes that into account when they decide to declare the dividend. Remember, you don't have a right to a dividend. You only have a right to a dividend if declared. Now, there's some other calculations that come from that as well. And so ratio is division. Almost all of the Series 7 is division. So if you can't decide what to do, you hit the divide key. I'd be doing you a great service to cover every calculator up on your key except the divide key. So here, as we remember, we had 40 million. We had 40 million in current assets. That was a number I just made up. It's given information. So there was our current assets, CA, current assets. And we had $10 million in current liabilities. And so we have a current ratio of 4-to-1. We have $4 in current assets for every dollar we have in current liabilities. Now, if you want in this lecture, you can always stop. I give you the information and you can, try it yourself, right? So, you can hit this pause button and try it. I'll tell you what I'll do moving forward in this lecture. I'll give you the numbers and then I'll give you a shot at it and then I'll show it to you. So another ratio that's based on the balance sheet, that's where we're talking with corporations first. We're talking about Series 7 math calculations. We're talking about the balance sheet and some things that we get from the balance sheet. Another thing we get from the balance sheet is the acid test or quick ratio. As you recall, we had $40 million in current assets. And of that $20 million we had in current assets, 20 million of that was inventory. And as we said, we don't want to have to sell our inventory to pay our bills. because then we inventory reduction sale, we don't get as much money for that. And so if we were looking at the quick assets in this company, I'll give you a chance to try if you want, kill the video feed now and tell me what are the quick assets of this corporation. If a corporation has $40 million in current assets and $20 million of that is in inventory, what are the quick assets? And so here we say the quick assets are divided by the current liabilities. Look like I got a typo there, liabilities. And that's called the asset or quick ratio. So let's see if you can do that. You now have the 20 million in quick assets. And what are you going to divide that by? You're going to divide that by the quick assets by the current liabilities. And we have 2 to 1. 2 to 1. Debt to equity, debt to equity. So on the balance sheet, in the asset side, right, we have current assets, we have fixed asset or long-term assets. On the liability side, we have current liabilities and we have long-term liabilities. The money that's actually involved in running the business. So we said the balance sheet is going to balance. And so we're going to have some long-term debt on the balance sheet, bond money. This week, Monday, JP Morgan issued $13 billion in long-term debt, followed Tuesday by Bank of America issuing $15 billion in long-term debt. That's the bond money. And then we also have shareholder equity, right? So, if I made up a balance sheet and I said we had $100 million in assets on the asset side, and then we had bond money and we had shareholder money, how much would that be, right? So I'll make up a number. Let's say that we have $40 million worth of bonds that the corporation has issued. $40 million in bonds the corporation has issued. And shareholder equity, the money that they didn't, they started with and the money they retained that they didn't pay out as a dividend. Let's say we have 50 million in shareholder equity. These two numbers together are called total capitalization. So in this example, we have a $90 million in total capitalization. We capitalize, a separate question, by the way, but the capitalization of a company consists of equity and debt. That alone could be a test question, right? Capitalization is long-term debt and shareholder equity. So in this example, we have $90 million in total capitalization, 40 million from bond money and 50 million that our shareholders put up originally or shareholders decide to leave in. Each at the end of each quarter, we go over the quarterly resorts, the board, and we decide if we have earnings, how much to retain and how much to pay out as a dividend. Here, whatever those combined numbers are, it's 90 million. Now to get the debt to equity ratio, what we're going to do, as you hear, is we're going to take the long-term debt and we're going to divide by total cap. Let's see if you can get that one right. You're going to take the long-term debt divided by the total cap. So you can hit pause now if you'd like. And here's our 40 million in bond money, long-term debt. And then we're going to divide that by our total capitalization, which is 90 million. And I'll just do that on my calculator. 40 million. 40 million divided by 90 million. So that means 44 cents of every dollar does not belong to the shareholders. 44 cents belongs to our bondholders. Now, this ratio here is about solvency. We have too much debt. We're not going to be able to pay it, and we're going to go poof. Capitalism without failure is kind of like religion without hell, right? So Now, the previous ones, again, I wouldn't worry about it as a test issue, but the previous ones we looked at, let me just clean up the slide here. The previous ones we looked at were about liquidity. So that's liquidity, all that's liquidity, solvency. All right, so our next one is price to earnings. This one's high risk, high probability. I can't imagine any exam in which you don't get asked about price to earnings. We use this to make comparisons of companies. Bankers use this if we're going to take a company public. What's the PE ratio, the comp PEs for other publicly traded companies doing the same thing or something similar. We have people use this to buy undervalued stocks or buy the overvalued one because they're going to think they're going to grow into it. But you're going to have to do this. So I'll just make up one. Let's say the price is 48. Whoop. And again, if you want to try these, you can always hit the pause button. And so I'll just make up the price. The price is 48. So that's the current market price of the stock. I just made that up. And I tell you that it has $4 in earnings per share. $4 in earnings per share. Now, what is the PE? What is the PE? And you would take 48, the price, and you would divide by the earnings, and we find out the PE ratio. Let me get my calculator. Is 12. So in theory, it would take me 12 years in earnings to get back what I just paid in price, what I just got paid in price. Now that earnings per share, we might, in terms of fundamental analysis, be making the assumption that that's going to grow or that's going to fall, but we might use forward or trailing, but on the test is a pretty straightforward issue, the PE. I had a candidate who sent me a practice question where they gave them 2 of the 3 and they had to solve for the third. So it was kind of basically you had to plug this in. In other words, what the candidate guys with practice problems was missing. And then they wanted them to tell them what this missing number is, right? What is X? So if 48 divided by something is 12, but when you get those kind of questions on your exam, just remember in a math question, the good thing about a math question is all the numbers that are provided to you, one of them has to work, right? So, what I told the candidate they should do is just start plugging in these numbers until one of the ones offered would end up getting them whatever that number is, right? So that's one way to proceed on those kind of questions. Well, in our example, we said that the earnings per share, the dividend payout ratio, this is a low probability, but I would be able to recognize companies based on their, dividend payout ratio because we, the board, as I said, gets together. We just had, in this example, we had $4 in earnings per share. So the board, we say, hey, listen, we just had $4 in earnings. What do we want to do with that $4? How much of that do we want to retain? And how much do we want to pay out to our shareholders as a dividend? Do we have excess capital? We associate dividends and treasury repurchases with companies that are mature and stable and generating more than they need. And maybe the board says, let's declare a dividend of $2. So they decide to pay a $2 dividend. So they had $4 in earnings, and the board said, let's leave half in the corporation as retained earnings, and let's pay out the other half to our shareholders. And you would tell me that the dividend payout ratio is 50%. And we take our calculator to divide by 4, we get 0.450. By the way, 0.50 is the same thing as 50%, right? If you have 50 cents of a dollar, you have half of that. So, and then again, dividend payout ratio would tell us if it's 1%, it's probably a growth company. If it's 80%, probably mature, stable business, right? So we can make assumptions based on that number, whatever that number is. There's no draw in which you're not going to have to do current yield. No draw in which you're not going to have to do current yield. And let's say that a company, I'll just make up again one. Let's just make up one. A company has a quarterly dividend of 35 cents. A quarterly dividend of 35 cents. And has a current market price, trading on the current market price of the stock is $30. What is the current yield? What is the current yield? As I told you, the vast majority of your division or math on the test is division. So if you can't decide what to do, you want to divide. The other thing I always tell candidates is RTFQ. Make sure you're reading the full question. Because if you miss this, you can make a mistake right out of the gate here by not realizing that we need to times that by 4, right? We need to know what is the annual dividend. So if they give us the quarterly dividend, we're going to have to figure out what the annual dividend is. We times that by 4, that would be $1.40 is our annual dividend. You know, how did I get the $1.40? I took the quarterly dividend times 4. So, you know, they might give it to you. They might make you figure it out. So now I'm back in business. So $1.40. You know, I always think about current yield as what an investment pays me, what an investment pays me by what it costs me. So what this stock pays me is $1.40. And what I paid to capture that $1.40 was $30. That was the current market price. And so I'm going to take my calculator. I'm going to take 1.40, the annual dividend. I'm going to divide by 30. And I find out the stock has a current yield of 4.6. 4.6. Again, I don't know of any draw in which you're not going to have to tell me current yield on your exam. So current yield is the annual dividend divided by the current market price. Now, preferred stock, you're going to have to be a little more careful on preferred stock because, you know, in preferred stock, you might have to do an intermediate step, you know, because you might have to figure out the annual dividend. So let's give you one to try. I'll tell you it's a 6% preferred. It's a 6% preferred. See, now what you got to be able to do is figure out what that is in terms of a dividend. So, you know, you have to say, oh man, I got to figure out what that is. And maybe they tell you that the current market price of the preferred is $90 per share. I just made that up. So what you're going to have to do here is you're going to have to say, well, that 6% is based on par. And so this is going to pay me $6 annually. $6 annually. So now I'm back in business because the current yield is going to be what it pays me divided by what it costs me. And what it pays me is $6. And what it costs me to get that $6 is going to be 90. And so we take 6 and we divide by 90 and we find out it's 6.6 is the current yield. So again, you're going to have to do current yield on something, whether it's a common stock or a preferred stock. And so a current yield on a preferred stock, the way we do that is we take the annual dividend. Remember, you might have to figure out that annual dividend because that annual dividend may be expressed as a percentage on par, right? So you might have to, you know, kind of stop and figure out what that is. So current yield on a corporate bond. Again, you might have an intermediate step here that's going to be required, right? Because the expressed as the coupon rate, the nominal yield, or the fixed or stated rate of return. You know, what will they call it on your exam? Whatever you're not prepared for. So you might have to work for this based on me telling you, for example, that it's an 8% bond. And then you say, I got to say, okay, well, that 8%, the issuer says, we don't care who's got the bond. We're paying 8%. That's based on par. And so you're going to have to figure out that that pays $80 in annual interest. So again, you might have to do this intermediate step. And then remember the bond's price is going to be expressed as a percentage of par. So, maybe I say it's trading at 92. And you need to know that's 92% of par, which is 1,000. And you would tell me that bond is trading at $920. Now that means, P.S. This isn't a lecture on interest rates. This isn't a lecture on yield to maturity and yield to call, but interest rates have gone up, and that's why this bond has gone down. And then what we do again is what it pays me, $80 in annual interest, divided by what it costs me. And let's get our calculator. By the way, I suggest you get a simple function calculator, right, when you're practicing. And 80 divided by 920 is 8.6, 8.7. By the way, on your exam, it won't be the difference between getting it right, 8.6 or 8.7. It'll be whatever, as close as you pick, whatever approximates your LED display. Parity of the common stock. Listen, this is very testable. Whoop. Very testable. I can't imagine any draw in which you're not going to have to do some kind of a parity calculation. This is math here that you've got to be able to do as a matter of routine. You can't be fumbling around with this. In fact, let me get out a text box because this is really important. And one note you got to make to yourself is when given the conversion price, you need to establish the conversion ratio. So if we get a conversion price, we're going to have to figure out the ratio. I'm going to show you how to do that in just a sec. So I tell you that it's a convertible bond, and I tell you that the conversion price is $40. Now, the very important thing for you as a test taker is the minute you see that $40, you got to say, whoa, whoa, whoa. I don't need the conversion price. I don't need that conversion price. What I need is the conversion ratio. So before I can do any of this math, which is taking the current market, before I can do that, I got to figure out what this conversion ratio is. Now, on a good draw, maybe they'll give it to you. But the way we do that is that was based on when the bond was issued, and that's based on par. So we're going to take par, which is 1,000. We're going to divide by the conversion price, which in this case is 40. And now we're back in business because when we do that, we'll have the conversion ratio. I'm going to take 1,000, divide by 40. And I found out the conversion ratio is 25 shares. And that's what I need first. So the first thing I'm going to need to figure out is what is the conversion ratio. So to say this bond has a conversion price of 40 isn't really helpful. What we need to know is that conversion price is a ratio of 25 shares. So now I'm back in business. So what I want to be able to do now is I want to be able to figure out I'm just trying to get myself some more room here. It's not letting me erase the way I want to erase. Let's just clear this slide here and we'll go back. So what we've established so far, I just want to put this over here so we have some more room to maneuver. We have established the conversion ratio. And we said that conversion ratio was 25 shares. And so we said that's an intermediate step that we might actually have to figure out. And we figured that out. We took 1,000 divided by 40 and we came up with the 25 shares. Now to get parity of the common stock, we're going to take the current market price of the convertible. So maybe your client is considering buying this bond for, I'll just make up a number, 130. Your client is considering buying this bond for 130. And remember, in bond speak, what that is 1,300. So that's the current market price of the convertible. The current market price of the convertible. And then what we're going to divide that by is the conversion ratio, which in this case was 25 shares. And then what we get is parity of the common. And so we're going to take our $1,300, given information. Your customer is considering purchasing a convertible bond for $130. It has a conversion price of 40. We don't need conversion price 40. What is parity, or what would be your client's minimum expectation on the stock? And we said, well, if my client pays $1,300 for this and it's convertible into 25 shares, he'd be paying $52 for the stock. And so he finds that an attractive number. Maybe this is an investment that he'd want to consider. Now, in the real world, the stock would typically be the common stock or market price of the stock, not the bond, would be something a little below that, maybe like 50, for example. So that's one scenario we got to be able to do. Another scenario we got to be able to do on the test is parity of the bond, parity of the bond. So that's going the other direction. So let's do parity of the bond. All right, so, now I tell you the stock, I give you the stock price, right? Remember, we had a conversion price. Let's get our thing going again. We had a conversion price of 40. And remember, that was when the bond was issued. The conversion price was 40. And we had established that if the conversion price was 40, more importantly, the conversion ratio, that's way more important, was 25 shares. We had established that. When this thing was issued, the bond would probably be, the stock 37, 38. And, let's say that after the bond was issued, the stock went up, and now the current market price of the stock is $50. And so now we say, well, if we can turn this $50 stock, that's the current market price of the stock. And if we can turn that into 25 shares of the common stock, right? That's what we can do here. We can turn it into 25 shares. What is parity of the bond? What should the bond be worth as a minimum? Right. Parity means equal. So, if we could get the bond for this, it would be equal. Now, in the real world, the bond would be trading at a premium. Well, even on the test world, to be honest with you, it would be trading at something north of that. It'd be trading at a premium to whatever that number is, right? So if you do that, remember at the end, the issuer, this isn't a lecture on convertibles. I have a whole beautiful lecture on convertibles. I highly recommend it. I know you're not surprised. That being said, this isn't a lecture on convertibles. It's a lecture on calculations, doing the math. But remember, then you got to know the implications of the math on the test. It's not okay. Sometimes it's just a math question, practical application. Let's take a little breather here. The three styles of questions you get are recognition, practical application, and judgment. And all the math questions are practical application questions. There's no interpretation about the parity of a bond when the stock's at 50 and you take 25 shares is this. And you really got to be able to get those questions right, because you got to save your misses for those judgment questions. About 10% of the exam are judgment questions. You go, you don't have to, you can't give up recognition, like when do options expire. So even if you don't like math, you kind of got to embrace it, because, there's no interpretation. I'm not a particular guy who loves math. I have friends who are serious math lovers. That's not me, but you need to embrace it on the test. Now, P.S., one more point here. If we saw this thing trading at something less than parity, there would be an arbitrage opportunity. Arbitrage is profiting from price discrepancies. And so, if somebody would sell that bond to me for like $1,100 when it's worth $1,250, I'd say, man, you must be new, and I would buy that. So, you won't see an arbitrage opportunity except perhaps on your exam, but if you see one in the real world, give me a call. Give me a call. By the way, this so far the most important ones we've done thus far in this requested lecture, Series 7 math calculations, was current yield and parity calculations. Those are the two biggest, three biggest, however you want to classify it in your own brain housing group. So just by way of review, parity of the convertible, we take the current market price of the convertible, our current market price of the stock, times the conversion ratio. So we had current market price of the stock was 50. We times it by the conversion ratio, which was 20 shares, or should be 25 shares, I think is what that was. Right? 1,000 divide by, what was it, $50 a share was it was $40 a share, right? So 1,000 divide by 40, 25 shares. So remember, I just had to do what we told you need to do, which is establish the ratio. And we came up with 1250. Okay, so I told you the way I've organized this math laundry list that was requested is by the various types of securities. So we have corporate securities, and we talked about the math involved in corporate securities. And now we're going to talk about some math on the muni bonds. And you have to be able in the test. This is, again, right up there with parity. So now let me rephrase what I said. In this lecture, the most important math is current yield, parity of the bond, parity of the stock, and the two I'm about to show you, tax-free equivalent yields and taxable equivalent yields. So let's say I'm looking at a corporate bond that pays, I'm looking at a corporate bond that has a 9% coupon, a 9% fixed or stated rate of return, a 9% nominal yield. And remember, the first thing I got to do is figure out what that is. That 9%, remember, is going to be $90. But of that $90, I'm in a tax bracket. I don't get to take it all home. And so I got to figure out, after I give back whatever I owe in taxes, how much am I actually going to be left with? Because remember, if I buy the tax-free bond, I'm not paying taxes, is the point. So, they tell you on the test, your client's considering buying a 9% corporate bond. Your customer is in, they give you a tax bracket. Maybe they say he's in a 30% tax bracket. What is the tax-free equivalent yield? So the way I do that is I'm going to take 100% minus his tax bracket, which is in this case 70%. I'm going to take the taxable yield times that. And I say, okay, well, 9 times 0.70 equals 6.3. So here's the point. If we can't find a muni bond that pays more than 6.3, he should buy the corporate. If we can find a muni bond that pays more than 6.3 with a similar credit quality, similar maturity, well, then maybe that's what we want to do. So that's why that math is important. So your client's considering purchasing a 9% corporate bond. Your customer's in the 30% tax bracket. What is the tax-free equivalent? What is it to 9 in his bracket? What's it look like after he pays his taxes? It looks the same as if he got 6.3 and didn't have to pay taxes. Right, that's what that means. So you got to take home 6.3 of that. Now, the other thing you're going to have to do is go the other direction on this. The other direction. And again, this is math you can't be fumbling around with. Is compare the muni to the corporate bond. So another thing I'm going to have to do here is go the other direction. And so to go the other direction, your client is considering buying a 4% tax-free bond. Your client is considering buying a 4% tax-free bond. Your customer is in a 40% tax bracket. What is the taxable equivalent yield? What does he need to be able to beat to get something like that? And boy, both these formulas I would memorize. So they're right up there. So far, current yield, parity calculations, tax, and taxable equivalent. So the way I do this is I take the 4% muni, the tax-free yield, and I divide it by 100% minus your tax bracket. And I get what's called the taxable equivalent yield. This muni that pays my customer 4% without having to pay taxes, he gets to keep the 40 cents of every dollar. So I'm going to take 4 and I'm going to divide by 0.60 and 6.6. So if I can find a corporate bond paying 7, that would be the better deal, right? If that's getting his bracket. In his bracket, getting 4% is the equivalent of getting 6.6 taxable. On a bad draw, I might actually make you do the math and then do that. But remember, you're always going to give 2 of the 3 givens. This is a given, right? And the bracket is always a given. By the way, in both versions, let's do both versions here. In both versions, the tax bracket is given information, right? That tax bracket is going to be given information in both of those. And so on the taxable, if it's a taxable yield, you multiply. And if it's the tax-free version going the other way, you divide. So if they give you the corporate bond, you multiply. Muni bond, you divide. All right, this one I don't think, I haven't had anybody in a long time tell me they've seen this. Calculate percentage sales charge. But, if you get a bad draw, I mean, you should know that the legal limit in a mutual fund, is 8.5%. You should definitely know that. In the old days, there, used to be questions where you'd have to do this and figure out if they're in trouble or not, or figure out whether it's a closed-end fund. And so, the sales charge would be given, and then the offering price would be given, and then they're going to ask you the percentage sales charge. Now, on a bad draw, maybe they don't give you the sales charge. Maybe you have to figure it out. Maybe I tell you the fund has an NAV, I'll just make up one, of $9.15. That's the net asset value. Test question, it has to be calculated every day. We're always doing business based on the next calculation. Test question, forward pricing. And let's say the public offering price is $10. And so, you might have to figure that out by taking the 10 minus the 9.15 and find out the sales charge is 85 cents. And then what I do is I take the 85 cents, the sales charge, and I divide it by the public offering price. And assuming this is an open-end fund, that would be the maximum legal limit. Again, I don't think this one is as high a risk as some of the other ones we've been discussing, but, figure put it in, leave it out, may as well put it in. By the way, remember these lectures, I don't know where they come in because I believe in doing whatever the appropriate length is. I tried to keep them what I call a study block. I think you should carve out study blocks of 45 minutes to an hour and a half, and, maybe 2 a day or 3 a day, depending on whether you're working full time. And I try and make the lectures fit into what would be somebody's typical study block. But I'm not really concerned when lectures go over the hour or hour and a half. Very rarely do they, but remember there's a pause button, so you can hit the pause button and do whatever you need. So calculate percentage public offering price, sales charge divided by that. We showed you that one. I didn't show you the other version here. I don't know if I should, but I'll go ahead real quickly. So it doesn't look like I have a slide for this one. And so I'm just going to go ahead and do it anyways. But the other thing I might want you to do is when I give you the NAV and the percentage sales charge, recalculate the pop. Now, again, it would be a draw from hell to have to do this. But if you do that, the way you do it is you take the NAV and you divide by 100% minus the sales charge. And that would give you the public offering price. So, maybe I say the NAV, let's just do the one we did previously. So now I'm not doing the percentage. I'm showing you how to recalculate this. The NAV is 9.15, but maybe I say you qualify for a reduced sales charge. As you recall, I showed you the maximum at 8.5%, but maybe they get a break point of 6.5%. And so if they get 6.5% instead of 8, they're not going to have to pay the $10, which is why they should try and do that. So you always do things in parentheses first. So you always do that math first. And if I do that, I take $9.15 I divide by 0.935, and I find out that would be $9.78 as a public offering price. So that would be the other version of that. All right, I put out a poll when we were doing the person who requested this lecture on math. I said, well, should that math include break-evens on options? Should that math include break-evens on options? And the poll came back, yeah, let's do break-evens on options. So this isn't an option lecture. As you know, on the YouTube channel, we have 10 hours plus of content on options. We have lecture 1, Introduction and Nomenclature, lecture 2, Basic Options, lecture 3, Stock plus Options, lecture 4, Multiple Option Strategies. That's like 7 hours. And then we got, a couple practice exams for you and a couple other goodies for you. So, but the consensus was you'd like to do that. So break-even calls, call up. It's going to be the strike price plus the premium. The strike price plus the premium. Let me get a stock price right now. Let's say that Apple is trading at 125. How convenient. So, I buy an Apple 125. Let me get out my annotation tool. I buy an Apple 125 call. And let's say I pay 8 for that. My break even would be 133. It's the same break even whether you're going long or short. So if you were long this contract, you'd want it above 133. And if you were short, you'd want it below. But it's the same break even. Good mnemonic that we use is call up. Call up. The break even and strike call contracts is strike price plus premium. And then what I would suggest is you put a little arrow next to it, the break even, where you want it up or down. So if I were long this Apple's 133 or higher, I'm a winner. 133 or less, I'm a loser. Good way to remember that is call up. Okay, so that's the break even and call contracts. Remember, we have an options matrix. Some people call it home base. We have plenty of. So this isn't the point of this lecture. Isn't to teach options or lecture options. The point is just to give you Series 7 math calculations. All right, so break even and call contracts. We said that Apple is 125. We looked at a call contract. So let's look at a put contract. So there's our put contract. That's the strike price. And let's again say the premium is 8. What is the break even? So we take 125 minus 8, and we find out the break even is 117. Now it's the same break even whether you're long or short. It doesn't matter where you want it. So if I'm long the put, I'm going to want it down from this number. And if I'm short the put, I want it above that number. Again, this isn't an option lecture. It's just a Series 7 math calculations, break even. So, I'm not pretending that I'm teaching options right now. I'm just showing you the math. A good way to remember this is put down, call up, put down. Great mnemonic for break evens. Now, remember, those were our 4 basic option transactions, right? Because we have calls and we have puts, and you can either buy them or you can sell them. But remember, we also have multiple option strategies. And one of those multiple option strategies we have are straddles and combos. Combos are straddles with different strike prices. And so we said that Apple, let me get out my annotation tool. We said Apple right now is 125. That is the current market price of Apple. And we paid 8 points for the call. And we paid 8 points for the put. And so if we do both of those at the same time, we're going to be out 16. And so we're going to have 2 break evens. We're going to have what's called our upside break even. And we're going to have what's called our downside break even. Now, again, remember, you only remember one thing. Remember, call up and put down. Call up, put down. So what I'm going to do is I'm going to take the strike price, XP means strike price, and I'm going to add the combined premiums, the total premiums, 16 in this case. I'm going to buy. By the way, it doesn't matter what I buy or sell. It'll be the same. And my break even, my upside break even is going to be 125 plus 16, 141. That's my upside break even. By the way, if I'm a short, it's the same thing. I still combine them. Buy, add, sell, add. If it's the same type of thing, you do that. And remember, the put was 125 minus 16. And so 125 minus 16, I need either 16 points up or 16 points down. And again, I'm not doing straddles and combos. I'm just doing math. I'm not showing you, there's 4 test questions about a straddle. Can you identify it? Can you calculate the break evens? Can you determine where it's profitable and when to use it? That's not what we're doing right now. We're doing Series 7 math calculations. And the calculation is the break even in a straddle, or the break evens in a straddle, or the break evens in a combo. A combo is just different strikes, and you do the same thing. You add to the call, subtract it from the put. Call spreads, we have a great mnemonic for break even and call spreads. And the mnemonic, again, is call up. Call up is a great mnemonic, but we also have one here called CAL. CAL. And CAL stands for call, add to the lower. In a call spread, you're going to take the lower strike. So, let me just put this one up here. Let's put one up here. I go short 10 Apple December 125 calls at 8. And I go long 10 Apple December 135 calls at 2. And so what I've done here is what I'm spreading is the difference in those premiums. That's why it's called a spread. This is a credit call spread. Again, I'm not lecturing here. I'm just going over this. We have a whole lecture, an hour and a half on spreads and straddles. Here, I'm just trying to show you the break even. But one test taking trick that I can't resist showing you is that, it'd be bad form on your exam to pick any break even that isn't within that range. I mean, whatever that break even is, it's got to be somewhere between 125 and 135. So you could, in your answer set that they offer to you on your exam, you can eliminate, get a 50-50 because there's going to be 2 choices that aren't in that range. And then what Cal reminds us, call, add to the lower, is that we're going to take the lower strike. Now, I don't mean lower on this screen. The lower strike. XP means strike price. We're going to add the net premium. Doesn't matter whether it's a debit or credit. Doesn't matter. Whatever those net numbers are. When we buy and sell, we net. Net there is 6. And we get our break even of 131. So the way we get a break even in a call spread is we take the lower strike and we add the net premium plus the net premium. With that number, in our example here, we take the lower strike, we add the net premium, we get our break even of 131. Call up. Put spreads. We have a nice mnemonic for put spreads. The mnemonic we have for put spreads is push. Push stands for put, subtract from the higher. Put, subtract from the higher. The way I'm going to go break even a put spread, put, subtract from the higher. Push. And higher strike minus net premium. Call up, put down. So let's put a spread up here. And again, I'm not lecturing multiple option strategies. I'm just showing you break evens. And so we go long 10 Apple December 130 puts at 13. and we go short 10 Apple December 100 puts at 7. All right, so what I've established there is a debit put spread. And, I'm not lecturing spreads right now. But again, we said one test-taking trick is you shouldn't tell me on the exam you're going to get a 50-50 by just knowing that whatever that number is, it's got to be somewhere between the strikes. And what we're going to do is we're going to take the higher strike, which is 130, higher XP. We're going to subtract the net premium. The net premium here is 6. Again, it doesn't matter whether it's a debit or credit, doesn't matter. And we get our break even of 124. Right, then you need to know bullish or bearish, separate issue, but you want it down from that. This is a bearish spread. That's, again, I'm not lecturing options. I'm just showing Series 7 math calculations. All right, so call up, put down. We got 2. We got cal. We got push. Then remember, besides the speculative positions, by the way, I can't resist. I can't help myself, but the credit call spread is, I'm protecting myself. And the debit, I'm lowering my out-of-pocket cost. But all right, so we also have covered calls or buy rights. Covered calls or buy rights, where we buy the stock and we write the option. Whenever you sell options, it's a minus. When you buy them, it's a plus, or if you short. So anyways, let's put one up here to look at. I buy 100 shares of Apple today at 125 a share. That's what it's trading at right now. And, if that's all I do, my break-even is 125. But, why not get paid to agree to sell high stock I just bought low? Somebody will give me hundreds of dollars in advance to agree to sell Apple at a higher price. And so I'm going to lower my out-of-pocket cost. And by doing so, I'm going to get some price decline protection. I'm going to have a break even that's lower than this. So I'm going to write. Now be careful. I'm not going to test you on ratio rights, but you can only write as many contracts as you have stocks. I can write 1 Apple. Now I need to decide how long I want this to be obligated to deliver my Apple. The longer term option will give me the greater premium. So maybe I go for a leap. It stands for long-term equity appreciation or appreciation potential security. Woohoo! Long-term equity anticipation potential. And maybe I go out, this is 2021. Maybe I go out to 04. Wow. Yeah, wow. I'm going to get some big juice on this. Technically, leaps go out 39 months. In practice, they go out 30 months. But now I need a strike. I'm about to put in a ceiling. So the less bullish I am, the lower the strike I'll write. In fact, if I'm bearish, I'll write an in the money call. The more bullish I am, the higher the strike I'm going to write. If I'm neutral, I'll buy it at 125 and I'll agree to sell it at 125. Here I'm going to go for the 140 calls. And as I mentioned, I'm going to get some big time money for that. Maybe I get 14 for that. So I paid, I like to use T's. Some people like to use minuses. If you get good at a T, I don't know where you're at in your study effort, but to be honest with you, I don't know anything break evens. If you understand them, you don't need to memorize a bunch of stuff. But here we paid 125 for the Apple. We paid 125 for the Apple. We brought in 14 points for the option. And so our break even is going to be 125 minus 14, 111. Now this is the one time and the one time only that I have a call and I'm actually minusing to get the break even. Because this is not an option position. This is a stock position. So that's kind of important. So this is the one time only we have a call. This is what's dominating is that stock right there. Now, you probably see if you've been following my lectures, the way I like to do options is dollars out and dollars in. So we paid 125 for the Apple. We brought in 11 points for the option. And so then Dean could chop. The reason I like the way Dean does it is because I can shop my answer set, and I know that it's got to be a number that if I plug it in there would make the thing balance, right? Or excuse me, uh, yeah, I lose 14 points. I got 11 points. That's how that works. I just want to make sure I'm doing the math right. 125 minus 14 is 111. That's our break even. And I said, if you want to do the T, you could just take the T and just track the money in and out, right? So we have 125 out for the stock and 11 points in for the option. And then you can just net the numbers until you figure out one that works. All right, then remember the other one we have, let me clean this up. Stock cost minus premium. Is the protected put, where I buy the Apple at 125 again, and then I buy some protection. I buy some protection. So the Apple's 125. And let me put it up here and we'll look at it. It's the one time, by the way, we have a put and we're not subtracting to get the break even. So I buy 100 shares of Apple at 125 a share. And again, if that's all I did was buy 125 shares of Apple, the floor would be 0. But I decide that what I'm going to do is I'm going to buy some term insurance. And so I decide that what I'm going to do is establish the choice to sell my Apple between now and, the longer I want the protection in place, the more it's going to cost me. December, and maybe I say I want to be able to sell it at 110. Well, let's get the protection. Higher the strike, the greater the protection. And maybe I can get that done for 4 points. And so we paid 125 for the Apple. We paid 4 points for the protection. And so now our break even is 129. This is the one time and the one time only that I have a put and I'm actually adding. So when you have stock, you got to be a little more careful. You got to switch gears mentally and say, okay, when I got stock, I'm either going to be adding or subtracting the option. I'm going to add if I'm buying, or I'm going to subtract if I'm selling. And so, I use a T. So Dean's would look like this. I paid 124 for the Apple, 4 points for the protection. And so my break even is 129. As I mentioned, if you get good at the T, you don't need to memorize break evens. You can just track money. But, this lecture is about Series 7 math calculations. Again, I'm not lecturing here, but this is a pretty smart thing to do, right? I'm not lecturing ops is what I mean. All right, so margin was the last thing. Margin, not high risk on the test. So I guess let's just review basic Series 7 math calculations. Current yield, very important. Parity is very important. Tax and tax-free equivalent yields, taxable and tax-free equivalent yields, very important. Break evens and options is very important. Other stuff, not so much. Including margin, maybe 3 questions on margin. Sometimes people tell me less, sometimes people pay me more, but it's not a target-rich environment. But one thing I might want to be able to do is figure out how far down a stock could move before I'm going to have a problem. So, the way I do that is I take the debit register, what I owe my brokerage firm, the debit balance, and I divide. So if I owe my brokerage firm $20,000, that's the debit register or debit balance. I divide that by 0.75, and that tells me how far down the stock could go before I would have a problem. So I divide by 0.75, and that's 26,666. That's market value at maintenance. So the reason that's helpful is I know now that if the stock goes below 24 grand, my collateral, I'm going to have a problem because that's below that number. I know that at 30 grand, I don't have a problem because it's above that number. So that's kind of a handy formula to be able to figure out market value at maintenance. The classical margin equation. The classical margin equation. And so if you want to be able to get a margin, you don't overdose on margin. Again, I have a whole lecture on margin. I love it. And my lectures I think are wonderful. know, um, that's one of my favorite lectures. I think it does you a service. Very rarely in most lectures, I tell you what I'm doing is supplemental to whatever other study effort you're doing. But my margin lecture stands alone. I mean, you could just do that margin lecture and take your test and you'd be fine. But this is, again, Series 7 math. And part of that math is doing margin accounting. And so let's just buy 1,000 shares here at 40. And if you want to be able to get margin down, what you should be able to do is the classical margin equation long and the classical margin equation short. Now, I notice, I don't know, as a subscriber, how long you've been with us or how many lectures you've watched, but we're working our way through an explication right now of the Series 7 FINRA content outline. We're in function 3 and a margin is in function 4. So at that point, when I explicate that function 4 margin, the margin lecture, what I'm doing now, I would tell you just do margin on the YouTube channel and be done with it. But anyways, at $40. So here's a client who buys 100 shares of stock at $40. I'm going to say, do you want to do that in your cash account or do you want to do that in your margin account? As a margin clerk, I want $40,000 from you. You say, Dean, let's do it in my margin account. I say, okay, so I need you to put up $40,000. That's long market value. My brokerage firm will loan you $20,000. That's called the debit register or debit balance. And that means you're going to have $20,000 in equity. That's what we call our original setup. And then what we're going to do is we're going to need to mark to market based on the stock going from perhaps 40. Let's say now the stock goes to 50, and I'm going to mark you to market. That's what that's called. And to do marks, you got to know that classical margin equation, which is long market value minus debit balance equals equity. I think a good analogy is a house. Market value of the house minus mortgage on the house equals equity. So now we're going to go $50,000 in long market value. You still owe the brokerage firm $20,000. If you sold the stock, nobody's suggesting you do so. But if you did, equity always represents what you would have if you sold the stock. Nobody's suggesting you do that. Again, this is the biggest thing, the classical margin equation. Now, we love lending customers money. And so, what I love to do is compare $50,000 to Reg T, because I want to see if perhaps I can't loan you more money. It's one of my all-time favorite things to do. And so I say, ooh, you have $5,000 in excess equity, more than you need. Kind of cool. You say, well, Dean, in my home, when I have excess equity, they're willing to advance me a further loan. I said, we are the same way. As brokers, we love advancing loans. And right now I can advance you another $5,000 because on $50,000 in collateral, I'm allowed to lend you 25. You've only bought at 20. Reg T, Federal Reserve Board says you only need to be at risk for half, which is 25, and you're at risk for 30. You can have that as cash or you can buy additional securities. You say, do I have to do something today? I say, I'll tell you, no, tell you what I'm going to do. I'm going to make a special memorandum to your account that on today you had $5,000 more than you needed. And you can either have that as cash or 2 times that is your buying power. Again, don't overdose on this. I wouldn't even, be studying the good news because we don't test you on the good news. We test you on your ability to call a guy and tell him he's got some bad news. So when a customer has over 50% equity, he's got this excess equity, he can have his cash. So in terms of math, right? That was how I figured out what that account looks like. Now, the most important thing is the long market value minus debit equals equity. The classical short equation is credit balance, cash, minus short market value equals equity. So let's do that. So here's an example where I call my broker and I say, hey, I want to sell short I want to sell short 1,000 shares of SeaWorld at 30. He said, well, Dean, let's call stock loan and see if we have a customer who signed the loan consent form. And they say, Dean, we do have a customer who is long SeaWorld and he signed the loan consent form. So if you'd like, Dean, you can do that. So I'm going to get 30 grand. SeaWorld is a $30 stock. This is where most people get hung up, by the way. I'm going to get 30 grand from selling the borrowed stock. And then Reg T says I have to put half with that. My Reg T requirement is 50%. So I'm going to have to put up 15 grand. And so there's going to be $45,000 in my account. That's the credit register credit balance. 30 grand from selling the borrowed stock plus the 15 I had to put with it. Now the second ledger line still represents what I owe, but what I owe is securities. And the securities I owe right now are valued at 30,000. And that's called the classical equation short. The classical equation short. You know, and again, the most important thing in this Series 7 math calculation lecture is to know the classical margin equation short, right? Because you need that if you're going to do marks to market and you're going to see what's going on. Again, this is not a margin lecture, but you know, this is 30% minimum. The previous one was 25%. You know, this isn't a margin lecture, it's just a math lecture. All right, so let's see. So that's our classical margin equation short. You say, well, Dean, how far up could the SeaWorld go before there would be a problem? I said, ooh, why are you going to send out negative energy like that? So, you know, we sold short 1,000 shares of SeaWorld at 30 grand. As you recall, our credit register, credit balance, cash in the account was $45,000. So the way we do that, is we take the credit register, the cash in the account, which in this case is $45,000. That was our credit register. We divide by 1.3, and then we find out how far up the SeaWorld could go before I would have a problem. You know, maybe I put a buy stop there, or, you know, maybe I buy a call or do something. You know, selling short is pretty dangerous. All right, so I take my 45 grand, I divide by 1.3, and I find out if the SeaWorld goes above $34,615, $34 a share, I'm going to have a problem. Now that's pretty helpful, by the way, because that means I know that if SeaWorld is 32,000, I don't have a problem. I know if it's 40 grand, I have a problem. So it's kind of nice to know where is that problem going to come up. It's going to come up when it goes above that. All righty. So this was the requested lecture on Series 7 math calculations. Oh, that was the wrong one. We'll put this up for Premiere. I usually like to put it up, our lectures premieres, you know, 2-3 days out, but I want to make sure I'm available because what we do on chats, you wouldn't be hearing this unless you're a Series 7 because it won't be in any other playlist, but we run a Q&A alongside the chat. And in the question and answer chat that's live, I answer any question you have about either the Premiere you're watching, math calculations, or any other question you have on Series 7, or for that matter, any question you have on any FINRA or NASA exam. So if the word gets out, I hope it does, or you're an SIE or you're a 65, 66, or whatever you are as a candidate, feel free to join us on those live Q&A chats. Okay, that fills the request. Let's talk about the upcoming other premieres. If you're an SI, well, you want to hear this, you're an SI. I'll just give you the premier schedule or previews for Series 7s, because that's what you are if you're watching this lecture. We're going to continue on with the explication of the Series 7 content outline. As I said, we're currently in function 3, and we've got 2 more sections there in function 3 because we chunked it. So I think two or three functions, 2 or 3 chunks in that function 3. And then we have function 4, and that will complete the explication of the Series 7 content outline. And we have plenty and plenty of Series 7 content. So if you have a request like this one, please put it in. But I'll probably not be doing, after we get through that explication of the Series 7 content outline, we need to put up some more for our 65, 66 candidates. I'm going to be working on that. We have plenty for our SIEs, but we haven't finished that explication yet. So I want to explicate the SIE content outline or test specifications, and same for 65, 66. So if you're a test-taking weekend warrior and you're one of the Series 7 test-taking weekend warriors, I think I'm going to post this for a Sunday premiere, just so if you're working on Sunday, studying, you got something to do if you want to break it up a little bit. Okay. Thank you for joining us, and stay dedicated, disciplined, and organized. And I'm sure you're going to make your mark.